Hey there, this is Jeff Reeves. I'm the editor of InvestorPlace.com. I'm here with Charles Sizemore, the editor of Macro Trend Investor. Charles, let's talk Target. Let's talk some retail. Retail numbers have not been so hot for Q1. Some people blame the weather. Go figure. But some stocks have obviously had their own specific troubles. Target's one of them. It's down about 20% in the last year while the market has rallied. A lot of people are hating on their big expansion into Canada. The company's lost about $1 billion on that so far. Everybody hates Target. You do not. Explain to me why.
Perhaps I just love orphans. I don't know, but Target hasn't been able to do much right lately. They had that huge credit card data breach that was an absolute PR nightmare for them. Yeah, as you said, the Canadian venture has not been going well. They were really late to the e-commerce game as well. Up until I think 2011. They were actually piggybacking on Amazon.com's infrastructure. They didn't even have their own functioning website. So that's how kind of behind they've been on that. But okay, so that's the bear side. What's the bullish side? Well, to start, the obvious. It's been beaten down. Nobody likes it right now. So whenever you see that, that's an indication you could start hunting for value. Doesn't mean you should immediately buy, but it means you should start looking, right? But looking further under the hood there, Target is one of the most shareholder-friendly companies I have ever seen. They have raised their dividend every year since 1967. And over the last 10 years, a 10-year stretch there, if you recall, the last 10 years have not really been kind to the U.S. economy. We've had the nastiest recession since the Great Depression. It's been one crisis after another over the last 10 years. And Target has managed to raise its dividend at a 20% annual clip. Just think about that, 20% annual clip. At that rate, you are doubling the dividend every 3.5 years. And on top of that, if that wasn't enough, they've also managed to shrink their share count by about 1/3 over the last year. The last 10 years, I should say. That's huge. That is shareholder friendliness par excellence right there.
So where's all this money coming from then, Charles? I mean, do they actually have the ability to keep this up? Are they going to continue to do buybacks and raise their dividend? Or are they kind of at a ceiling here? Because if I'm looking down the road, if there are pressures on earnings and revenue, as it seems like there are after this kind of Canada debacle and the data breach, where's the money coming for that to continue going forward if I don't own it yet? I mean, nice for people who've had it for a decade, but what if I'm buying now?
Sure. Well, so this is the story there. I would say for the next year or two, dividend growth will probably be a little bit muted. I think it will grow, but not at a 20% clip. Share buybacks, that may be put on ice for a while until they get through this rough patch. However, looking at Target over the last 20 years, they've, 20 years is a long period of time there. You've had some ups and you've had some downs. Their growth rate, their dividend growth rate over that period was a good 13%. So let's say that over the next couple years, rather than grow that dividend at 20% a year, it's more like their long-term average of 13. Let's say it's even less. Let's say it's 10. That's still fantastic growth in an economy that's really not growing that fast. And how is that even possible? Well, at the end of the day, Target is still a discounter. I mean, it's not a high-end store. It's one small step above Walmart. It's a store for the masses whose objective is to make decent product, not even great products, mind you, just decent products available at a great price. That is a business model that should do just fine in a not a horrible economy, but in an economy that's only growing in fits and starts.
So then basically what you're telling me is that if I'm a swing trader, maybe don't even worry about Target, but if I am a long-term investor looking for value over the next couple decades, I can buy now, get a fair cost basis on a dip, and expect big dividend growth. I mean, if we are talking a 10% annual growth rate, I mean, you're not going to double your dividend every 3 or 4 years, but you are going to double your dividend every 7 or 8. That ain't so bad, right?
Well, it sure beats buying a treasury bond, right? And that's how I would put this. I would say for a long-term income investor, Target is a no-brainer. This is something you should own. This is something you should buy and forget. If you don't need the income today, reinvest the dividends. If you do, just take the dividend check every quarter and be happy. If you're a shorter-term trader, I think just the sheer volume of bearishness against the stock right now, everybody hates it. I think it is an intriguing contrarian buy in the short term just because the sentiment is so one-sided. that's a less committed trade, of course. I would say, the bigger story is if you want something that's going to pay a good dividend for a long time to come, a company that treats its shareholders very well, Target is definitely one to consider.
Well, there you go. That's definitely the other side of the trade there with everybody bearish on Target. So thanks for the insights, Charles.
You bet.